Tax-advantaged accounts are one of the best tools for retirement that exist. No one likes to pay taxes, and when it comes to saving and investing for retirement, they can be one of your biggest expenses. Of course, you should try and minimize your taxes if you can, and tax-advantaged accounts are a fantastic way of doing so. Hello, my name is Monahan. I'm a real estate agent in Portland, and let's get right into talking about tax-advantaged accounts. Before that though, please be sure to like the video if you're enjoying it so far. It does really mean a lot. And definitely be sure to subscribe as well if you enjoy personal finance and real estate related content. Anyway, let's get into it. Now first of all, what actually is a tax-advantaged account? Well, a tax-advantaged account is exactly what it sounds like, an investment account that provides a tax benefit. Specifically, it provides either a tax-exempt or tax-deferred benefit. For tax-deferred accounts, otherwise known as pre-tax accounts, these accounts allow you to deduct contributions from your current yearly income. You'll pay less on taxes now, but you'll still pay taxes in retirement. Examples of this type of account include a traditional 401k and traditional IRAs. And secondly is what's called tax-exempt accounts. Otherwise known as after-tax accounts, these accounts provide a future benefit. You'll pay taxes now on your income, but the money will grow tax-free and you won't owe any taxes when you make withdrawals in retirement. An example of this type of account includes a Roth 401k and a Roth IRA. And overall, tax-advantaged accounts are just an investment account that provides a tax benefit either upon deposit or withdrawal. If these definitions of these types of accounts are not immediately clear, don't worry, I'll definitely provide some more further detail when highlighting the three main types of tax-advantaged accounts. But now, let's actually talk about what the benefit of a tax-advantaged account is. The benefit of a tax-advantaged account is that you get to keep more of your money in retirement. It's pretty straightforward. How about we say that you put $10,000 invested in a Roth IRA instead of a taxable account. Well, 40 years later, at a 7% return on your money, the money would grow to around $150,000. With a usual taxable brokerage account, you would be taxed on all of the money that you made, and a decent chunk of that $150,000 would go to taxes when you withdraw. However, if you put your money in a Roth IRA instead of a regular taxable brokerage account, you wouldn't have to pay any money in taxes on that investment, assuming you wait until retirement to withdraw those funds. The $150,000 that you made is worth $150,000, not less thanks to taxes. Using the same example, if the initial investment had been made in a tax-deferred account like a traditional IRA, you'd actually have more money to contribute up front since you'd be paying fewer taxes on your income. Let's assume that you make $50,000 annually and your current income tax rate is 20%. Round numbers make things easy even if they're not necessarily fully realistic. Now let's say that instead of paying $10,000 of taxes on your $50,000 income, since you're contributing $10,000 to a tax-deferred account, you'd only pay $8,000 on taxes on the $40,000 of taxable income. You could, in theory, invest the extra $2,000 you would receive in tax savings, bringing your initial investment to $12,000. Now this $12,000 would grow to be around $179,000 over that 40-year time period, but you would still have to pay capital gains taxes on that investment, but you would be left with $154,000 after it was all done. The flip side of this benefit is that these types of accounts usually come with restrictions. There's a limit on how much money you can contribute and when you can access your money and more. And we'll get into those details when I talk about those types of specific accounts later. Now, let's finally talk about the three major types of tax-advantaged accounts. There are three major types of tax-advantaged retirement accounts that will fit within the tax-deferred or tax-exempt buckets that I outlined earlier in this video. First of all, let's talk about individual retirement accounts, or IRAs for short. There are two different types of IRAs, a traditional IRA and a Roth IRA. A traditional IRA is a pre-tax account that allows you to take an income tax deduction in the year the contributions were made, lowering your own tax bill. However, you then have to pay ordinary income tax on your withdrawals in retirement. A Roth IRA, on the other hand, is an after-tax account in which you contribute after-tax income that will grow tax-free. Come retirement, you won't have to pay any taxes on your withdrawals. Both types of individual retirement accounts have a similar set of rules. Like for example, the max contribution in 2021, the maximum of money you can contribute to either type of IRA is $6,000 annually, or $7,000 if you're over 50. Money withdrawn before the age of 59.5 as a 10% early withdrawal penalty. The one exception is that you can withdraw your contributions to a Roth IRA, not capital gains, at any time penalty free. In regard to traditional IRAs, you must start withdrawing from the plan at age 72 to avoid penalties. This is also known as your required minimum contributions, otherwise known as RMDs. And your ability to contribute to a Roth IRA reduces and eventually goes down to zero if your modified adjusted gross income is above certain levels. If you're single or filing separately from your spouse, the limit is $125,000, and if you're married filing jointly, the limit is $198,000. For traditional IRA, the limits depend on if you qualify for a retirement plan through work. If you do not qualify for a corporate-sponsored plan, then there are no income limits. Keep in mind the $6,000 limit applies to both types of IRAs. You can contribute $6,000 to one account or $3,000 to each, but you cannot contribute more than $6,000 to both types. The second thing that I want to talk about is 401ks and similar accounts. Similar to IRAs, both traditional, pre-tax, and Roth after-tax versions of a 401k plan exists, but the availability of them depends on what your employer offers. The traditional 401k is much more common. One of the biggest differences between a 401k and an IRA is that a 401k is an employer-sponsored account, and that your contributions can be made more easily automated. You tell your employer how much you want to contribute, and they will automatically withhold the money from your paycheck and deposit it into your 401k for you. Similar to IRAs, there are definitely rules to be aware of with 401ks. In 2021, the maximum annual contribution for any individual is $19,500, while the maximum contribution between the individual and the employer is $58,000 annually. Money withdrawn before the age of 59.5 has a 10% penalty, and similar to traditional IRAs, you must start withdrawing from the plan at age 72 to avoid penalties. And the biggest benefit to a 401k is that it oftentimes comes with an employer match. An employer match is a contribution that your employer makes to your account on top of what you contribute. For example, your company may match 50% of the first 6% you contribute, which would equate to an extra 3% contributed to your retirement account. For someone making $50,000 annually and contributing 10% to their 401k, instead of investing $5,000 annually, they'd be investing $6,500 annually thanks to their employer match. The employer match does vary by company, and some don't offer it at all, unfortunately, but you should 100% take advantage of it if you have it. For those who work at a company that doesn't offer a 401k, you may have some other similar options available to you. 403b plans are similar to 401ks, but are available to employees of tax-exempt organizations such as public schools, religious organizations, and hospitals. 457 plans are similar to 401ks, but are available to state and local government officials and some nonprofits. And then solo 401ks are similar to 401ks, but are available to business owners with no employees. And lastly, I want to talk about health savings accounts, otherwise known as HSAs. A health savings account, or HSA for short, is an account you can set up to pay for out-of-pocket medical costs and healthcare expenses. In order to qualify for an HSA, your health insurance plan must be a high-deductible health plan. If you qualify, you can open an HSA through your employer and have them automatically contribute funds on your behalf, or you can open an HSA on your own. The larger rule to be aware of with HSAs is the annual contribution limits. In 2021, the annual contribution limit to an HSA is $3,600 for someone on a self-only plan. The maximum contribution limit is $7,200 if you're on a family plan. The biggest perk of an HSA is that it's both tax-exempt and tax-deferred. You have the option to use your HSA as a retirement savings account, or you can invest your money. The money you contribute is done on a pre-tax basis, and you can also withdraw your funds tax-free assuming you use them for qualified medical expenses. Even the investment growth can be withdrawn tax-free if it's used for qualified healthcare costs. However, even if you don't use the money for qualified medical expenses, after retirement age, you can withdraw your money without any penalty. You will just need to pay ordinary income taxes, similar to a 401k. Now, there are some common questions that I get asked about tax-advantaged accounts that I do want to answer here, so let's go over them quickly. 1. Should I really be using tax-advantaged accounts? Yes. Without a doubt, if you're eligible and have access to them, you should be using tax-advantaged accounts. They are the best tool available to you to build retirement savings, which everyone really needs to do. If you're not sure where to start, I will have all the options listed in the description below, but let me give you a quick talk on what I would do if you are considering your options for investing in tax-advantaged accounts. First, you want to get your employer match in your 401k, then you want to max out your IRA, then you want to contribute to your HSA, and then go back and finally max out your 401k. On step 2, most people opt for a Roth IRA rather than a traditional IRA, but it depends on your tax situation now and how you think income taxes will change for the future, which is really anyone's best guess. And if one of the options isn't available to you, just skip it. Number 2, aren't tax-advantaged accounts less flexible? Yes, all tax-advantaged accounts come with some set of rules. That is the trade-off for getting a break on your taxes. The opposite of a tax-advantaged account is a brokerage account. A brokerage account is a taxable account. You don't receive any tax savings, but you have the maximum flexibility. You can contribute as much money as you would like and withdraw it whenever you like as well. Number 3, do I need to max them out? No, but it's definitely not a bad idea if you can. Before maxing out any retirement account, you need to get your overall personal finances in order, which means paying down any bad debt, saving an emergency fund, getting necessary insurance, and ensuring your short-term goals are covered. One example of a short-term goal could be saving for a house. If, after maxing out all tax-advantaged accounts, you are only left with $100 in savings each month, it will probably take you a long time to save up for a down payment. It might be smart to actively make the decision to not max out your retirement accounts so that you can save money for a house and accomplish that short-term goal. From there, it becomes a decision if you need flexibility before retirement age or if you want all the tax advantages you can get. The answer will help inform how much, if anything, to put into a brokerage account or non-tax advantaged investments before maxing out your tax advantage options. While this is definitely not an exhaustive list of every tax-advantaged account in existence, it does highlight the major accounts that a majority of investors should consider when planning for retirement. Tax-advantaged accounts are one of the best tools for retirement out there, and if you have access to them, you should be taking advantage of them to set yourself up for future financial success. Now, thank you all so much for watching. I hope you learned a thing or two about tax-advantaged accounts. Please don't forget to like the video if you liked it. It does take quite a bit of time to make each video, and be sure to subscribe for 2 videos a week on real estate and personal finance related content. Until next time, bye.